highly appreciated assets so that if you don't want to pay the taxes on those, but you want to give somebody the benefit of the capital, you can gift that asset straight over to that person, and their lower tax bracket can pay for the gains. So for example, if you make less than, I think it's like $46,000 a year or something like that, your capital gains tax is 0%. 0%. So if you have a beneficiary that has that low of an income and you have significantly appreciated stocks or other securities in a taxable account, that's a gift that you can make that's helpful for you tax-wise because you get to get rid of that tax liability, and potentially they can pay even zero taxes. So the main thing that we're looking at when we're looking at our tax efficiency is our lifetime tax expense. How can we keep our lifetime tax liability as low as possible? Now that just has to do with, where are we contributing when we're contributing to accounts like tax deferred accounts or tax-free accounts, Roth IRAs and IRAs. But then it also comes to when we're distributing assets to ourselves, are we doing that in the most tax efficient way? Because obviously these different types of accounts have different behaviors when it comes to tax liability. A tax deferred account is going to be fully taxable when you take that distribution immediately. So a good thing to consider is if you don't need the distributions from something like an IRA, a very useful tool is if you actually don't need the distributions and you just want the account to keep growing and you don't need any more tax liability, you can do a direct donation from your IRA, which is called a QCD or a qualified charitable distribution, directly to a charitable organization and never recognize the income from that account. So if the income is not necessary, you can push it off that way and continue to grow the account. Usually required minimum distributions are going to be lower than the returns we see, so you're able to let that account continue to grow. Now again, those estate tax considerations. For the most part, we're not going to be dealing with estate taxes or like that big, because we have that giant exemption, 14 million, 14 and a third or something like that. So that's not really usually going to be our main consideration. But like I said, with asset distribution, considering who's going to receive what kind of assets is important. Lowest income beneficiaries should receive the highest taxable assets. For example, IRAs. It's a great thing to leave to somebody with a low tax bracket because all of that money gets taxed to ordinary income. So the more we can fill up the lower tax brackets with that and then push capital gains to somebody else who might pay 15% or 10% or 0%, that's more helpful because the total sort of liability across all of that goes down. Yes.
Just give the cash, or do you just give the stock?
Yes, so you can do both. You can gift either stock or you can gift cash. The benefit of gifting stock is if you're sitting on an appreciated position. So for example, if you've got like an S&P 500 fund and you've been holding it for several years or a decade in a taxable account, a trust account, or an individual account, you can actually gift those shares directly to the person if they have their own brokerage account. You can send it from your brokerage account straight to theirs, and then you basically just release that property and you never have to sell it and realize the capital gains on that and pay the taxes. So that if you were thinking about giving them $10,000 of cash, but you have $10,000 of appreciated stock, for you, it's going to be more beneficial to gift them that stock because you won't have to realize the gains on that. So that's like a 15%, tax. Yes, so they would need to have a brokerage account to receive it so that they can sell it or keep it or whatever the case may be. Yeah.
Is that something you have to do sort of officially, or can you just do that via, in other words, by that I mean through, you have to let the IRS know and stuff like that, or is it just, let's say I have 10 shares of, Google or whatever, and it's appreciated, I want to transfer that to my nephew?
Yeah, so that'll depend on the value. So up to about $19,000, there's an annual gift exclusion where you can gift up to a certain amount to as many people as you want throughout 1 year's period, like the tax year. And that you don't have to file a gift return or do anything for. You can just do whatever you want, and then you don't have to do anything. It's not going to matter. But once you go past that, you have to file your gift tax, or you have to file a gift tax return so that you either elect to pay the taxes or it just comes out of your lifetime exemption, which is that 14 million.
So under 19,000?
I believe so, yes. It was 18,000 last year, I think, and 19 this year, I believe. So what is tax efficiency? Well, Investopedia says that tax efficiency is when an individual or business pays the least amount of taxes required by law. So again, it's not necessarily that we're completely avoiding the idea of taxable income or capital gains. We're just trying our best to pay the least amount of taxes as required by law. So this is very valid. This is something that we want to try and do absolutely. But just because something's tax-free or taxed less, it doesn't necessarily mean that it's going to be the best choice. Now, the easiest possible frame of reference for this is when we look at bonds. Because as we know, interest from corporate bonds are fully taxable as ordinary income. You don't get any qualified income. You don't get to pay capital gains rates. They're fully taxable. So if you have a taxable corporate bond paying 5% and you have a tax-exempt bond paying 3%, which by the way, at this point is generous. Most of them are paying 2 to 2.5%. And you have a tax rate of 25%, it's still not necessarily super helpful to choose the tax-free bond, because if you were to actually just take a quarter out of that 5%, it would remain higher than the 3. If this was only paying 4%, then it would be even. So you have to understand what the differential is. You have to understand sort of what the impact is. Now, of course, there are other reasons to reduce taxable income as well. Things like, for example, Medicare IRMA, the adjustment to your Medicare premiums is affected by taxable income. However, municipal bonds don't escape that. So they still affect your IRMA. They still affect the premiums on the Medicare, because that's dependent on your modified adjusted gross income, not adjusted gross income. So you're adding back municipal bonds and other things that would have reduced your income. So it's important to understand the relationship of tax expenses and returns, because we don't want to simply handicap our returns just so our tax bill is a little bit lower. Because sure, we paid less in taxes, but we also made less throughout the year. So that's not necessarily a good thing. So there's a couple things to consider when we're talking about tax efficiency management. There's sort of 4 different general things that I want to take into consideration. The type of account that we're looking at. So what is the actual behavior when it comes to taxes of the account? The types of investments that are in there. So how efficiently are they taxed? What is the taxability of the investment? For example, capital gains or dividends or capital gain distributions. The location of investments. So how efficiently they're placed. So this kind of ties right back to the types of accounts. But basically what this is saying is, combining these two, how efficiently is the taxation of the investments paired with which account they're in? So for example, if I have a bond fund taxed at ordinary income rates, if it's going to be taxed at ordinary income anyway, it may be better to put it in a tax-deferred account or a tax-free account, like an IRA or a Roth IRA. Because if I were to hold that same investment in a taxable account, well, then I'm going to be paying the taxes on the interest every single time that distributes. Now, if I were to use something like a dividend fund, where most of those dividends are going to be taxed at a qualified rate of capital gains taxes, it's going to be more efficient for me to keep that in a taxable account than for me to put it in a tax-deferred account, because those distributions will end up getting taxed at ordinary income rates versus me paying capital gains rates today. Now, of course, that's all assuming that tax rates stay stable the entire time, so that's another consideration. Preferential tax rates are also really important. That kind of ties into types of investments and location of investments as well. So really, these are all just sort of all pieces of the same puzzle, but understanding how and what types of rates that each capital gain, dividends, income, whatever's happening, understanding what rates it gets taxed at and when it's going to step up to the next rate is also really important. So we'll start with our account types. You'll be familiar with many of these, especially your tax-deferred accounts, because these will be the sort of things that you contributed to get up to this point, but we'll go through them anyway. So you've got two main types of accounts, especially we're mostly talking about investment accounts. So you've got your tax-advantaged accounts, which are accounts that provide some sort of tax benefit. Doesn't really matter which way it goes, but they provide some sort of tax benefit. You've got your tax-deferred accounts, things like traditional IRAs and traditional qualified plans, where your contributions are deductible in the year that they're put into the account. You've got your tax-exempt accounts, which usually you put a taxed dollar in, and then all of the earnings come out tax-free. So things like a Roth IRA or a Roth qualified plan like a Roth 401k. Then you've also got your 529, which is limited to qualified expenses. So it's not quite the same benefits as a Roth IRA, but it's kind of close. And you can also, with a 529, they introduced this, I think in the Secure Act 2.0, is that if you hold it for 15 years, you're actually able to transfer $35,000 worth of that 529 into a rollover Roth IRA. So it's a long time to wait for that rollover ability, but it is there. Next to that, we have our non-tax advantaged accounts, which is pretty much just all other types in which contributions are made with after-tax dollars and earnings are taxed for the year in which they're received or they're deferred until withdrawn. So we've got things like individual accounts, joint accounts, community property, trust and estate, all your sort of standard taxable accounts, custodial accounts, and then also business and entity accounts. We've also got, so when it comes to tax advantaged investments, tax deferred accounts, such as IRAs, 401ks, and others, enjoy a current tax deduction on the way in. So that's some money going in, you defer the taxes by deducting that. And instead, the IRS collects their share on the way out via ordinary income tax. And this means that any distributions that come from these tax deferred accounts will be taxed at ordinary income. There's no other way. You can't get capital gains. There's no qualified income, nothing. It's always ordinary income as it comes out. It's basically just going to be taxes if you've got a job for that amount. Roth accounts don't provide any deduction on the current year. However, the distributions are received tax-free following a few qualifications, age qualification and age of the account, which is about 5 years. So this makes Roth accounts incredibly valuable for young investors with long time horizons. People who have low tax rates and have long time horizons will benefit absolutely the most from these Roth accounts, because if you can pay relatively low taxes on the way in, let's say 10%, 12, 18, somewhere in that range, anywhere beneath 24, honestly, all of those contributions, and they'll grow with a long time horizon, some nice high risk investments that will grow over a long period of time, then all of that comes out tax-free. That's really, really powerful, because it's not going to, no matter what other stuff they've got going on, it's not going to impact that tax picture, because it's all going to be tax-free, which is really fantastic. That's why some people like to do Roth conversions for their beneficiaries, because they like to remove that tax liability from the person they're gifting it to. Sometimes the math can get a little bit complicated, so it's important to sit down and really look at what those numbers will look like, especially if you've got a complicated tax situation. Roth conversions there are reasons to do them and reasons to not do them. We'll go through those in a bit. Now, we've also got different investment types that can be more tax efficient. So we've got tax managed funds. We've got mutual funds that could be growth funds or balance funds or any sort of different types, but they aim to minimize the tax liabilities and enhance after-tax returns. So essentially, you can just have a growth fund and then a tax managed growth fund where their whole objective is to not create capital gains distributions for you. They're trying to maintain as little tax liability as possible going forward. Now, of course, if you don't want to deal with that affecting the investment strategy, an ETF is going to provide you the same tax efficiency. So an ETF, because they don't actually buy and sell stocks inside of themselves most of the time, they're not actually going to distribute those capital gains. So you're going to not need to be worried about them doing something extra to make the capital gains more efficient, because you will only realize it when you sell. You won't get distributions from the investments themselves, because it just basically never happens. Sure. Yes.
ETF, how do you, not clear to me, how did you get the revenue?
So when it comes to an ETF, the difference between mutual fund and ETF for the most part will be, with that mutual fund, it's more like a pass-through entity. So when they create income or capital gains inside of the fund, they're going to pass that back out to you. So that's going to be taxable. And so there will be, of course, the value of the share that can increase over time, but then also they will send out distributions of the profit that they made. So because of the structure of the ETF, because they're not sending out distributions of that profit, it essentially just gets baked into the share price. So the share price will sort of rise in the same way that the distributions would account for. So it's a similar return, it's just realized in a different way. Just the ETF doesn't actually send you anything versus the mutual fund will. So when it comes to treasuries, bills, notes, and bonds, which is just essentially names for the different maturity lengths, bills being a year or less, notes being a few years, and bonds being several years, they're not taxable at the state level. So if you're really concerned about tax efficient income when it comes to cash-like positions, the easiest place to go is to treasuries, because they still pay pretty handsome yields in comparison to corporate investments. So for example, I'll just show you one of the most popular treasury funds ever that everybody likes right now is SGOV. So we've looked at this one before for our example portfolio that we built. But what this fund essentially does is it will go and it will buy treasuries that have 0 to 3 months left on their maturity length. So they're close to maturing and paying back the principal. And you can see that the 30-day SEC yield is still about 4%. So that's still a pretty good yield on cash, especially for right now. And that's state tax free. And if I compare that to something that's relatively comparable, this has maybe a little bit longer of a maturity. So this is a ultra short-term bond fund from Vanguard, which has a 30-day SEC yield of 4.25. So depending on what your state tax rate might be, it's worth it to sort of compare these two back and forth together. So, that's an extra quarter point, maybe 0.3% that you're getting for extending your duration by a little bit and taking on some corporate debt risk. But again, these treasury bonds, they're going to be state tax free, which is pretty great. So, if you just want something that is relatively tax efficient, you're not going to be avoiding federal taxes, but treasuries are just a pretty easy pick because they'll pay close to whatever is the best rate that you can get on cash at the time, and it won't be taxable at the state level. Now, municipal bonds are sort of the answer to federal taxes. They're not taxable at the federal level, sort of period, for the most part, except for there is such thing as a taxable municipal bond, which I did not know until a prospective client came in and showed me their IRA with taxable municipal bonds in it. And I go, I've never heard of that before. So I had to do some research, and yes, there are indeed taxable municipal bonds. So I had never seen them before that point, and I hardly ever see them now, but they do exist. So the thing about municipal bonds, though, is that you start to sort of narrow down and concentrate that risk because they come from municipalities like states. So you're getting more to like the state is the one that's responsible for that bond rather than the federal government. So the federal government obviously has really deep pockets. In fact, they have pockets that they can just keep making bigger and bigger as much as they want to, obviously. Municipalities, they aren't always as stable. Municipal bonds can introduce some other risk. However, they're not taxable at the federal level. So if you're in a really high tax bracket, if you're sitting in the like 32 plus, this is probably going to be a healthy place to be. For the most part, people under a 32% tax bracket don't necessarily get a better return for the income. Like it's not more if you don't pay the taxes. So people in the lower tax rates will do the best with treasuries, and then some will do better with corporates. But if you really don't want to have taxable income and you just want to sort of maintain your same level of taxes, municipal bonds can be helpful. And then if they're from your state, if they're California, for example, you won't pay state taxes either. For some states that doesn't apply, but for the most part, if you have a municipal bond from your home state, you also won't pay state taxes. So this can be a completely tax-free asset, but you have to understand that you're also putting your faith in whatever government it is that backs that bond. So you may even consider the tax ramifications of growth versus value styles. That's also something to pay attention to. Value style securities, because the whole point is you're paying for cash flow more than you're paying for the idea of market segment growth, they will tend to pay out dividends because a lot of the times these value metrics will end up being on earnings. And then if it's a stable company that really likes where they are, they'll start to pay out their earnings as dividends. They'll put some of that aside. Growth investments are very rarely high dividend paying. It's just not really something that growth investments tend to do. So this means that more of the total return is simply the increase in share price, which is not a currently taxable event as well when it comes to the stock or the ETF. It can be currently taxable if you're in a mutual fund and they decide to sell out that position, but that's another conversation. So it only becomes taxable upon sale versus value investments often lead us to dividend-paying stocks, which creates more current income, which may be taxable at ordinary or capital gains tax, depending on the holding period of the stock or the fund. Exchange traded funds, like we talked about before, they rarely distribute capital gains like mutual funds do. They instead participate in what's called a like-kind exchange with an authorized participant. So instead of buying and selling stocks and bonds inside their portfolio, what they'll go is they'll go knock on the door of the firm next door and go, hey, I'm done holding my Apple position. I would like some Google. Can you go buy some Google for me? And then we'll trade. So then that authorized participant goes, buys for the best possible price they can. They trade the same proportional value of each of the stocks. So it might be 100 shares for 100 shares, might be 100 for 200, but they make that change. And because there's no sale, there's no taxable event. It just scoots on over, and now they have the new position. So because of that, the entity instead is the AP instead is the entity that buys and sells both the ETF shares as well as the investments used inside the fund. So for the most part, what the way that an ETF is created is the ETF company comes up with their investment strategy and they come up with the portfolio that they want to build. Then they generate all of their shares. Then they go on over to the authorized participant and they go, hey, I would like to build this fund. Can you help me out with that? So one or more authorized participants will then go purchase all of the securities that are going to build up that portfolio, and then they'll come and they'll trade them for the ETF shares. Then they'll go and they'll use their abilities to get the most efficient, market orders and limit orders and all that sort of stuff to basically buy and sell for the best possible prices because of their volume that they're working with. So they'll try and make money on the little teeny tiny spreads buying and selling ETF shares and stocks, and the ETF just works with that authorized participant to build their investment portfolio. That's basically what makes it so there's no capital gains distributions. Pretty much never will an ETF send out a capital gain distribution. It's just not really something that happens because of this structure, because there's no reason for them to. There's no reason for them to realize that current tax liability versus just keep pushing it off. So when it comes to location of investments, it's important to understand how the location of certain types of investments can impact their tax efficiency as well. This is what I was just talking about earlier. Dividends or interest that are taxed at ordinary income rates may be better off in tax-deferred or tax-exempt accounts if the income is not needed for distributions and current tax liability is a concern. If we're concerned about current tax liability and we want to hold, let's say, high-yield bonds, they pay more interest than pretty much any other sort of bond, more than treasuries, more than regular corporate bonds. They're going to pay that higher interest to compensate us for the riskier bond. Now, if we keep that in a taxable account, that's going to be all ordinary income. So that's going to be the highest tax rate that we could pay, besides leaving it in a trust for trust tax rates. So we might want to put that in a tax-deferred account where we're going to pay the same tax rates on distributions anyway, so we can defer it towards a later date, or put it into a tax-exempt account like a Roth IRA, where we basically avoid the taxes on that distribution, period, because we're not going to pay taxes when that money comes out. So for the same reason, mutual funds may also be better suited for those same account types. So if you're really insistent on some sort of growth stock mutual fund, or maybe like some long-standing American funds that you like, it might be better to keep that in something like a IRA account versus a trust account, simply because of the way that they distribute those assets out. However, if you're comfortable paying taxes via excess income, savings, or through investment distributions, holding mutual funds that distribute long-term capital gains or qualified income might be suitable, as the income typically will enjoy preferential tax rates. So let's go back to that situation again, where we talk about, say, an American fund's growth fund or some other mutual fund that distributes lots of capital gains. Usually, they try their best not to distribute what are called short-term capital gains, the ones that get taxed at your highest tax rate. Usually, they'll do their best to distribute long-term capital gains, which means that when you receive that in your taxable account, you're going to pay the capital gains tax rate, the 0, 15, or 20%, depending on your income. So it's not necessarily that it's the worst story ever to get capital gains distributions in a taxable account. It's just determining whether you want to defer them as long as possible, or if you're okay paying this qualified rate. Because this 15% on capital gains is not bad. So you can consult the IRS website and your tax professional for detailed help understanding your tax forms, but it's likely that you're going to receive some or all of the following here. For the most part, what I see for accounts through National Financial Services, which is Fidelity, you get a consolidated 1099 form So it's basically one big form that contains all of the different 1099 documents within it, but you might receive them separately, consolidated, however it might be. But your main ones are going to be 1099 div, which is for your dividend distributions, 1099B, which will be capital gains and losses, 1099 INT, which is for your interest payments, and then 1099 miscellaneous, which just kind of wraps up everything else that might have happened. So make sure to look at your 1099s to examine a couple key numbers. The two that I want to be looking at is I want to know, are we getting a lot of ordinary dividends? Are we getting a lot of short-term dividends or, corporate bond dividends or something like that that's being taxed at the highest tax rate? Am I getting lots of capital gains distributions, internal fund capital gains that are getting pushed out to you? And are they short-term or long-term? If we're getting qualified dividends and long-term capital gains distributions, it's really not that much of a concern. But if there's lots of short-term capital gains and ordinary dividends being pushed out, that might be something for us to look at. Now, again, if it's a good investment and it's something that fits your investment strategy or your investment policy statement or whatever you like to call it, don't let a little bit of ordinary dividends or a little bit of short-term capital gains push you away from the right investment strategy. That's going to be number one. So preferential tax rates. Investment gains and income can fall under a bunch of different tax rates. So it's important to understand how these fit into your overall plan. There's two sort of big categories that we're looking at. Number one is ordinary income. We know why we don't like this one as much, because it's taxed at our highest rate. Ordinary income will pretty much always be our highest rate of taxation. So you'll have things like ordinary dividends, non-governmental bond interest income. So like those municipal bonds are not going to be taxed at ordinary income, obviously. Treasuries are not going to be taxed fully at ordinary income. They'll only be taxed at the federal level. And then short-term capital gains. And then for tax preferred is a more favorable category that gets taxed at 0, 15, or 20% based on income. But then they also like to slap on this additional 3.8% net investment income tax, which is basically for people that make over $200,000 a year of taxable income. They just chuck on an extra almost 4%. So in this bracket is where you'll see qualified dividend income and long-term capital gains. Now remember, some people will get this mistaken sometimes. Long-term capital gains is 366 days, not 365. It's not 1 year of holding. It's over 1 year of holding. So if that's something that you're paying really close attention to, know that you have to sell on the 366th day to get a long-term capital gain.
What's an example of qualified dividend income?
So a qualified dividend income is going to be pretty much, it's going to be a dividend from a stock that's been held for 60 days. So if you hold an individual stock like Pepsi or Cola or something like that, the first 2 months of dividends are going to get taxed at ordinary income. But then once you pass that, all of the dividends get taxed at qualified rates, so that the capital gains rates. The same thing applies to ETFs for the stock dividends, not for bond dividends, so don't get that confused. But for the stock dividends, the fund has to hold it for 60 days, and then you have to hold the fund for 60 days. So it kind of doubles it up. Although if the fund has already held it for 60 days previously, then it's just you holding the ETF that matters. But essentially, you just want to hold the security for 60 days, then you start getting taxed at capital gains rates instead of ordinary income. So if you're committed to selling a position with a lot of gains, consider exploring some different ways of specifying what type of shares, which shares we're selling. So you can actually specify which shares do you want to sell when it comes to taxable accounts, specifically ETFs and stocks. It's really easy to do this because each share or each purchase or each lot, each time that you made a purchase is made up of a certain number of shares that are purchased at a certain share price on a certain date. So you can actually specify to your broker dealer or investment advisor, or whatever it is, to work on selling specific shares so that you get taxed the least. The default option for most broker dealers, so if you're at a Schwab, Fidelity, if you're using a retail account, the default option is usually going to be last in, first out, or LIFO. What that means is the shares that you bought most recently will be the first ones that get sold. For the most part, this ends up with the least tax liability because as the market has a positive skew, we generally go upwards in terms of returns. It means that the last share is usually going to be the one that you paid the most for. So then you sell that one and it's least likely to have a big spread of gain. Now you can also go the other direction if you would prefer to get rid of the high gain positions first or ensure that you're paying long-term capital gains rates with first in, first out, which is essentially just saying first shares that you bought will be the first ones that we sell. Next one is one that I don't know if every place will have an option for, but it's called highest in, first out. So you can actually specify sell the shares with the highest cost basis first, which essentially scans through all the different shares and will pick the ones that you paid the most for, sell those first, and then kind of go down, not dependent on date, but just dependent on how much you actually paid for the shares. Then, of course, if you want to get really specific with it, you can choose specific ID, which is saying, I want to sell that lot and that lot and that lot. And you're saying exactly which shares you want to sell because you have determined which ones are going to be the most tax efficient. So if you're not prepared to sell, if we don't want to sell this gain position, if we want to try and minimize this and we just want to work around it, we just want to make sure that our total asset allocation remains within our plan and we diversify around the gain positions. So something that I was talking about kind of before we started class is there were some people that were asking about sort of the valuation risks of the S&P, of the tech companies, of the sort of bigger exposure to these really big tech players. And so if your goal is to be diversified sort of away from those concentrations, you want to have a more even distribution of sector exposure or different types of stocks, then it's a really good idea to start looking at how can we diversify around this position that we don't want to sell. So let's just take an example. Sector funds are kind of the best way to deal with stuff like this. So if we're concerned about tech, we might consider investing around this position that has a high concentration in tech in all of the other types of sectors, everything else that has the lowest, starting with the lowest correlations. So you can go with things like consumer staples or utilities or industrials and start kind of creating the circle around the gain position that gives us more of an even exposure to all the different parts of the market so that we're not overly concentrated into this one thing. Now, if you don't have extra funds to contribute, that can be a little bit difficult. So there is something to be said about weighing the risks of holding on to that sort of concentration exposure versus accepting the tax liability and reducing it down by a little bit. So really just kind of weigh what's the most important to you. Now there's also tax loss harvesting. So what tax loss harvesting is pretty much just looking through your account, and if you've got losses on shares, harvesting those so that we can apply it against gains or we apply it against income. So if you don't already know, capital losses, if you have capital losses from an investment account, you can actually take up to $3,000 of that and apply it towards your ordinary income. Now, unfortunately, you can't apply capital losses against ordinary investment income, which kind of sucks. You know, corporate bond income, other types of interest income, and ordinary dividends don't actually get offset by capital losses, but qualified dividends and long-term capital gains, short-term capital gains, those do get offset. So when we're looking at tax loss harvesting, which is something that I was just recently doing because of all the volatility, was basically if we're looking at a position and we go, this one suffered a bit of loss, I have an ability to capture some of that and then also reduce another position that's concentrated. I'm going to do that and then rotate them to somewhat similar but not identical positions that still give me the same sort of exposure that I'm looking for. So for example, if I have a high dividend fund that just took a big loss, April was pretty rough for every type of stock. There was not much that escaped that. Sure, some of the values didn't drop as much as the growth, but pretty much everything got hit with losses. So if that high dividend fund drops, I can capture the loss. And if I invest in a value fund or some other equity income fund that doesn't track the same group of securities, I can get a very similar exposure, but I can also take the tax loss. So why am I saying to invest in something that's not identical? Well, that's because of a fun little rule called the wash sale rule. If you sell a security and you buy something substantially identical within 30 days, they disallow the loss and you have to use it later. They basically will just kind of go, we're going to push this off to the side. You don't get to use it because you got back in. So it's kind of like you were just selling it to take the loss and you got back in. We're not going to let you use that in the current year. You're going to have to push that forward. So it's important to not sell an S&P 500 fund at a loss and then buy another S&P 500 fund, because you're probably not going to be able to get to use that loss. And if you claim it, you'll probably have to pay that retroactively. So if you're looking to replace a poor performer with a cheaper, higher quality fund, this is a fantastic opportunity to harvest losses and offset gains on other positions. So if you're looking at a fund that you bought recently and then you realized, okay, this is too high cost, or it's too concentrated, or it's too something, and you have a loss on it, that's a fantastic opportunity to me, because we can capture that loss, use it against our gains, and invest in something higher quality. Now, what I will say is capturing all losses all the time, not necessarily beneficial. Use the opportunities when they present themselves, but don't assume that every single loser is a permanent loser. If you buy at the top of the market, if you bought first quarter this year and then immediately saw the decline in the second quarter, that was the entire market. Just because your investments dropped in value then doesn't mean that they're going to be horrible for the rest of time. It just means that we're in a period of volatility, and where you bought in is not going to be the bottom for the next period. It just means that you got to hold on for a little bit. If you can do some navigating and you can use that loss, fantastic. But you don't need to take every loss just because it's there. So when it comes to portfolio rebalancing and allocation adjustments, if your financial professional is reallocating your non-qualified or taxable account without considering your tax needs, you might want to rethink that relationship a little bit. What I don't want to have happen is that with no communication, tons of gains get pushed out to you from trades. If mutual funds distribute capital gains, there was nothing that they were going to be able to do to stop that. But if they're trading in and out of different things and they're sending you all these tax bills and you don't even really know where it's coming from, that's kind of a red flag to me, because I want to at least have a conversation with a person before sending them hundreds of thousands of dollars of capital gains. It's just not in their best interest to surprise them with that. It's possible that there's planning that could have been done to push this activity to a next year where it's more efficient to do so. So just like with any other professional relationship, communication is key. Being able to coordinate these things through proper communication is number one. Automatic rebalancing is usually not super suitable for a tax-concerned investor with a non-qualified account, though I will say the tools that professionals use or robo-advisors use these days usually will take capital gains into consideration. So for the most part, their rebalancing tools should take that into consideration for you, but it's just something to pay attention to. So when we're choosing a new position, it's important to be aware of the characteristics. Is the new position a mutual fund that can pay out capital gains? It's fine if it is, but just understand what that is, understand what the taxability of those distributions and how they fit. Is there a dividend? Are we going to be paying taxes on dividend income? Is the income tax advantaged? Are we not paying state taxes? Are we paying qualified capital gains rates? Are we paying no taxes at all on it? And how does that affect the returns? How does that fit into our sort of tax bracket? Now, I'll just put this up here. We're going to take our little 5-minute break before we get started into this, but this will be how we start talking about if you really want to be really efficient for taxes, how you could build a very sort of tax-favored investment portfolio. But we'll take a little bit of a break really quick, and then we'll come back to that. Oh. Here's something that we've had in the book for a long time. This is something that Bill put together a while ago. This is kind of like it's a stairway to tax-efficient heaven, if you will. So each step in the illustration sort of takes you up the stairway to invest for tax reduction. So, with most of these things, you're going to see things like tax-favored money market funds. So you can actually get municipal money market funds, which are pretty nice. So if you want to put something aside in a very stable investment that's just going to generate some interest, you can get money market funds that use tax-favored investments, whether it's treasuries or municipal bonds. You can get the characteristics of those investments in a money market fund, which is pretty fantastic. Gets really nice and stable, lower risk than any of the longer duration municipal bond funds, but gives you similar tax favor income. Then next up, you go towards a tax favored index or ETF income fund. So we're just looking at tax managed or tax favored income funds like municipal bonds or treasuries, or even qualified dividend income is something that I would be happy to put in an area like this where you're paying a better tax rate than ordinary income. Then we get up to tax managed growth funds or your index or ETF funds. So as the indexes don't change very often, they will be some of the best tax managed mutual funds. And obviously our index ETFs also share very strong tax efficiency, as the only gains you really ever realize are on the sale. And I think S&P index pays a measly 1%, 1.5% dividend still. Tax deductible retirement accounts. So getting that tax deductible contribution to remove that income from your taxable income. Personal residence actually is one of the strongest sort of tax favored investments because of the mortgage interest write-off that you get to have, where you get to write off up to the interest on up to $750,000 of acquisition debt. So that's that first mortgage to acquire the property. You can write off all the interest that comes off of that, which depending on your tax rate can be pretty favorable when it comes to a large amount of interest that you're writing off, when you can feel that growth from the real estate market. Now, obviously that depends on how long that time horizon is and all sorts of different things, but that's a pretty good way to get sort of a double up on providing a use asset for yourself to use and pay for, and then also get tax efficient returns over time. Then you've got your Roth accounts, IRAs, 401ks, Roth tax sheltered annuities, some of those like 403Bs and such, where you get that tax-free money coming out after you pay the taxes on it initially. Then we get up to our tax deferred annuities, which is kind of when I talked about annuities previously, I like to exhaust all other options before I choose an annuity, just because it's not going to be as efficient as the returns in an investment account or anything like that. But one thing that an annuity can provide is, especially if you're contributing, if you're accumulating assets, if you've exhausted all other options for tax deferral, annuities can make sense. They'll be kind of a hybrid of a traditional IRA and a Roth IRA in kind of the worst way a little bit. You get taxable dollars that go in, so it's after-tax dollars that go into the annuity, but then they grow tax deferred. They don't grow tax free, they grow tax deferred. Then when you annuitize the contract and you take out the lifetime income, a portion of that income is from the initial principal that you put in, which you don't pay any taxes on, and a portion of that income is from the earnings, which you then will pay ordinary income on as it comes back out. So it is a way to defer taxes on some of the earnings, which they can invest it however it is, whether it's a variable annuity or a fixed annuity with regular interest. That can push off some of the taxes on those earnings. So instead of doing an individual account where you realize the taxes in the current year, you might push them off for a while until you annuitize. Now that obviously comes with other costs, which is why we want to look for no load, so no front commission, no load on the front that we want to pay, low cost, relatively low fee. They can be kind of hard to find, especially as a retail investor. They're going to want to put you in these big complicated products that charge big fees. But if you can find something no load, low cost, they can be an all right tool. And then you've got your commercial real estate and of course your personal business, which if you're in a personal business, you can get some of your best tax efficient returns, because if you can spend a lot on taxable business expenses that are completely non-taxable, and then if you can have outsized returns compared to investments or real estate, then obviously that can be a pretty powerful way to go. So now we'll get to one of the conversations that people like to have the most, which is Roth conversions. So if you don't already know, if you have a traditional IRA, you can actually convert that from a traditional IRA account over into a Roth IRA. Now the reasons for this would usually be if somebody wants to move it over, pay the taxes on it today, and then allow it to grow for a long time so they can take the proceeds tax-free. So there's a couple reasons why we might want to do a conversion, and there's a couple reasons why we might not want to do a conversion. So the first thing that I'll say before we sort of jump into these is time is a really important factor here, because the differential in taxes, the tax rate matters, but also how long we have for the investments to make up for the taxes we paid is really important. Because if I pay 32% taxes right now today to convert, that account now needs to rise by approximately 60% in order to make back the money that I spent on the taxes. Any loss or reduction has to effectively be doubled in the opposite direction for it to be made whole again. Then it needs to continue growing on top of that for those earnings to be worthwhile. Otherwise, it would have been more beneficial for me to just leave it in there. Now, it also kind of depends on how the money is going to come out as well. You know, tax rates are important. So if you are in a lower tax bracket now and you want to move things over so that they have time to grow and you're not going to pull the assets out, you can pay lower taxes today, and then you can push that out and it can grow for longer. If you retired later in a year and maybe you can defer some income, so if you have maybe deferred compensation, or if you can defer compensation or a pension or something until the next year, and you can create sort of like this valley of income that you would have otherwise gotten, you can fill that with a Roth conversion, and then you'd be paying your normal taxes, and then you can have that invested in your Roth IRA. If you want to pay the conversion taxes for the benefit of your future beneficiaries, that's something that you can do as well. If, for example, you're in a lower tax bracket than the beneficiary you're expecting, then that might be a reason to pay the taxes today and allow that to grow and then be tax-free to that person. Or if you just want to remove the tax liability for them. And then, of course, there's also if you expect your future income will be higher or tax rates will rise. This is why we talk about recommending Roth accounts for younger people, because if the tax rates are expected to rise, as generally they are, or their earnings are expected to rise, as generally as you mature in your career they are expected to, a Roth account becomes more and more attractive. Because if you can pay less taxes today than you would in 10 years or 20 years, and you get to put the earnings of whatever investment on top of that, that's a pretty great gain. Now, the next thing to think about is what reasons we might have to not convert to a Roth IRA. First of all, is if the tax liability will move you up to a much higher tax bracket. Because you have to put this into your ordinary income tax brackets, it's going to start pushing you up. This might be a problem when it comes to, again, Medicare. Those IRMA adjustments, the ways that they add to your Medicare premiums. This will contribute to that. And one thing that's important to note is those adjustments usually last for a year or two. So you don't get, you will recognize that, and then the IRMA will jump and you'll have to pay that for at least 1 year, if not 2 years, before it gets brought back down. Yes.
Question from Zoom. The question is, what if you are in the 22% tax bracket and every dollar coming in will be at 22% and you won't hit the 24% bracket? What does it matter when you do a conversion?
Okay, so I think there's a little bit more context that needs to be in the question, but when it comes to tax rates, it's more about what's the difference between when the capital is going to go into the account versus when it's going to come out. If you're in a lower tax rate, I mean, for the most part, the conversions, if we're talking about like you have a traditional IRA and you're going to be taking distributions and all of it would be in the 22% bracket, or you could convert it into a Roth IRA. Again, it just depends on, are you going to be taking the income now, or are you going to take the assets out now? Or are you trying to pay the taxes now and defer it towards a much later goal? Again, time is like our #1 concern, because trying to like do a Roth conversion to like squeeze out every little bit of after-tax returns when you're already taking distributions from the account, it doesn't necessarily make a whole lot of sense. But if you've got time for the assets to grow and you expect the tax rate to be higher later, then you do want to pay the taxes now and allow it to grow. But again, I think there's going to be some more context needed. Yes.
On a simply cash flow basis, I wouldn't do the Roth. I would leave the money in the IRA and let it grow, because it will grow and provide more income in the future. However, if I'm worried that I might earn more or politicians may raise the tax bracket, then it's a way to pull money out early, pay the taxes, but then I lose the opportunity gain of the money that I gave to the government. I'm hoping my investments will grow. So low income, there's no real need to do it. But if you're not sure about future taxes, then it's a way to offshoot that.
Yep, exactly. And again, you just kind of want to make sure that that sort of delta between your current tax rate and what tax rate you expect is actually worth doing. Because again, if you're going to pay the taxes, it's going to reduce the principal value upon which you can have earnings. And you need lots of time for those earnings to catch back up to get you back to the original account value. So another reason you might not convert to a Roth IRA is maybe you don't have the money for the taxes set aside. Because again, if you're going to do this conversion, it's going to reduce the principal value of the account. If you want to maintain that same size and scoot it over, you're going to have to pay for that out of pocket. You can elect to use the money from your traditional IRA to pay the taxes. But again, like I said, if you're in a 24, 32% bracket, that's going to reduce the value of that account. And it's also, by doing that, going to reduce the amount of money upon which earnings will be applied. So if I have $1 million traditional IRA and I pay 25% taxes on it, and if I have it invested the same, if I don't pay out of pocket, if the account value is what pays for the taxes, the amount that's invested drops from $1 million to 750, right? And so now a 10% return on that is not going to be 100,000, it's going to be 75. So the earnings is going to be less in that first year, and the same kind of going forward. But if I'm able to pay out of pocket and maintain the same initial investment amount, the earnings will stay on that whole value, right? So I can actually get more earnings if I'm able to pay for it out of pocket with cash that I have, versus if I reduce the account value, because you can't contribute that extra $250. Remember, these Roth accounts have contribution limits of $8,000 a year. So it's not like you're going to be able to fill it back up to that initial value for the most part. If you drain that down, that's just a permanent loss of earnings that you now have. So it's important to consider how that all plays together. And then of course, if your taxes or if your tax rates are not less than what they were when you contributed to your previous plan, I mean, if you're going to pay the same tax rates now versus as when you would have contributed the money, I mean, there are some times when trying to do the conversions and to squeeze more out just isn't really worth your time. And it just would be better to leave it invested for the long haul. Yeah.
Can you do a partial conversion? So if you have $1 million IRA, you just want 100,000 into a Roth, you do that?
Yes. So I don't think you can do a partial conversion, right?
Don't we do them quite often?
Do we? Yeah. Do we do partial conversions?
Yes, we do partial conversions.
Yeah.
The other thing to consider is 3.5 years into the future, people making less than $75,000 each or 150 and a couple get that extra Social Security tax deduction, 6,000 each. So that may or may not help.
Yeah. So let's see. I'm just gonna verify.
And also, your standard deduction has gone up, or if you do itemized deductions, you have the SALT thing that went up to 40. So if you reevaluate your taxes, you might be in a lower bracket, and possibly that could be a good time to do a Roth.
So I think what I was getting confused was the backdoor Roth conversion.
Got it,
which is
you're
the
right.
One where you have, like, you can't have multiple IRAs.
Right.
That's a whole separate thing. But yes, you can do partial Roth conversions. That is possible. Yes.
Can you please go over the time rules on withdrawal from a Roth conversion, both initial amounts and earnings?
Can you repeat the first part of that question? Go over what?
Yep. Just basically, what is the time rules on the withdrawal from a Roth conversion, both initial amounts and earnings?
Yes. So I believe, let's see, I believe still the 5-year rule applies, where normally with a Roth account, when you contribute your initial dollars, they have to stay in the Roth account for 5 years. And then you have to meet the 59.5-year age requirement in order to take a tax-free distribution. I was just making sure. Yeah, so the same rule applies, that when you make that conversion, it's kind of treated as if it's a contribution. So it has to actually stay in that Roth account for 5 years before the tax-free withdrawals can happen. So that is something to be aware of. You need to be 59.5 to qualify, and the funds need to have been in the Roth IRA for 5 years. This doesn't apply to earnings. Earnings are their own thing because they were already in there. It's more about the principle that was originally put into the IRA. So, all right, our next thing, we'll talk a little bit about real estate deductions that we can have. So we've got For our personal residents, if you prepay some loan points on the first mortgage, those can be deductible. And then obviously, as we talked about, mortgage interest is deductible for most homeowners on the first $750,000 of an acquisition mortgage. So this is to actually purchase the property. It's not a second mortgage or a home equity line of credit, none of those things. But for the mortgage that you use to purchase the property initially, the interest on up to $750,000 is fully deductible against income when you itemize.
So it's 40,000, so
The-
property tax.
Oh, yeah, the salt tax.
Yeah, so that's the other thing that
Right.
here in the property taxes, this actually got increased by the OBBA, the One Big Beautiful Bill Act from Trump. So normally in California, our state and local taxes were limited to $10,000 of deductions, but now it's been increased up to $40,000. So if you pay a lot of state and local taxes, you're going to get a nice little benefit from that tax bill, which will reduce your taxable income by quite a bit.
And there's also an income limit. I think it's 250,000. If you go over that, it
Okay.
phases out. So you want to be careful about that.
Yep.
Points are also deductible in the first mortgage purchase.
Right, yes. So then you also have improvements, which aren't necessarily a tax deductible expense, but they are something that increase the cost basis. So for example, like if you buy a $500,000 property and you put in $100,000 of improvements, not maintenance, but improvements, you can increase the cost basis. So then if it were to sell for $750,000 later, if it was $500,000 and it increased to 750, that's 250 of gain. But if you had put in $100,000 of improvements, it's important to note those so that you actually don't pay taxes on the capital that you put in to improve the property, because that's not something that you should be taxed on because it's not a gain. Now, one of the great things about personal residences as well is something called Section 121 capital gain exclusion. This is if you are in a primary residence for 2 of the last 5 years, if you live there for 2 of the last 5 years, and you own the title on the property, you can actually exclude $250,000 of capital gains from that sale. So if you buy the property for $500,000 and you sell it for $750,000 2 or 3 years later, and you lived there the whole time, no taxable gains, none at all. And if you're married, it doubles up to $500,000. So that's another reason why the personal residences can be quite tax efficient, is because you have all of this deductible interest all the way while you're owning the property. And then as well, when you sell the property, you've got a giant chunk of capital gains that just don't get taxed at all. So it's a really good way to build some wealth and to create just kind of like a center for capital gains that don't get taxes. And then also you can get a step up in basis after death when this property is passed on, just like stocks or any other capital property. The cost basis of that will step up when it is inherited.
Question, owning title though does not include those who are continuing to be paying off the property?
So if you're continuing to pay off the property, yeah, you actually do still get the Section 121, the capital gain exclusion, right? If you still have a mortgage on it.
Oh, yeah.
Yeah, you totally.
absolutely.
So,
Yeah.
so it's not necessarily just the title. It's just
Yeah.
what would be the thing that proves ownership if you don't own the title? Would it just be owning the debt?
Well, the ownership is you'd have to live there, right?
No, that's the use test.
Okay, the
So there's
use.
use test, which is through the last 5.
The
there's
ownership would just
ownership.
be ownership of if the trust or you or anybody, it's capital asset.
So it's where it's registered to. or-
Yeah,
yeah.
to the person or
Okay.
you trust, and you don't, because it's a home or was a home, but now is a guest home or a rental, it's still an asset. So any asset, any real estate or stocks that go up in value, you get that step up basis.
Is there any thing like this for rentals and or second property?
And so do you mean when you're
Any
talking about this,
benefits?
any of these? Yes, we'll talk about those in just a second.
Yeah.
Next slide. Yeah,
It's not marriage.
right.
How's that work? If one person dies or one person leaves?
Yeah.
What about the other person? How's that taxed?
If memory serves me, each person gets their own separate $250,000 exclusion. If my memory serves me
Is that what
correctly.
you're referring to, living in a house?
Is
Uh,
that full If I have a house and I own my sister,
Yeah.
we're not married, so therefore, if one of us are gone, who pays the other how does that affect the taxes?
Well, you get the tax-free basis on the person that passes away, and the living person can sell the property, use their 250, but you can't use the 250 for a deceased person.
Okay, what is that? Not deceived, but they just decided they don't want it anymore, they're not.
You would both have to live there together and to get the 250 each.
Yeah, but only for 2 of the last 5 years. So if they leave, if 2 of the last 5 years, both of you still live there, that exclusion still applies. So,
If you,
Okay.
yeah,
if that person leaves, they could be gone for up to 3 years, and you could still both claim that $250,000 of gain exclusion. But it would be a separate 250 for each of you. You don't get to like bunch it up. But because it's on sort of the half interest, it kind of like is effectively the same thing. So it's like you get the 250 on your interest of the property. Yeah. So it's kind of like the same thing. It's just split. So next we have our rental properties. So loan points at purchase are something that can be deductible. Mortgage interest can be deductible. Basically all of the different costs that are for maintaining the property, and it's kind of like sort of business expenses. So sort of like all of the rental costs that would be the costs of doing business can be deductible. Things like even insurance premiums and maintenance costs, things that, you know, if it were a business that you would write off. It's similar for the rental properties. And then we have our favorite thing in the world, 1031 exchange. 1031 exchange is probably one of the most powerful tax efficiency things that really exists, especially in real estate, because what a 1031 exchange allows you to do is you can buy your first rental property, you buy it for $250,000, and maybe it doubles in value. It's now worth $500,000. But you don't want to pay the taxes on it. You don't want to sell, but you do want to move locations. You want to go to a different property. You're finished with this property. What you can do is you can get a qualified intermediary involved, somebody who sits in the middle of the transaction, who helps facilitate it. They can locate and determine a different property for you to move to, and you basically get to sell your current rental property and put all of the capital into the new property and not realize any gains on it, and carry your tax basis from the first rental property to the second. So you still have the same cost of $250,000, but the gain of $250,000, you just got to scoot over to the new property. And you get to do this indefinitely. You just keep going and keep going and keep going. So as your property increases in value, you can 1031 exchange from one rental to another, to another, to another, and just keep going for your whole life. You don't have to realize the capital gains. And with depreciation allowances, you're able to offset a lot of rental income. So if you're able to depreciate the property, you're able to offset income by showing how much value you basically would have lost that the IRS allows you to claim. And you can have a really good tax efficient return for a long time until you finally decide to exit out of the property and realize the capital gains from the entire time. However, what a lot of people will do is they will continue to 1031 exchange rental properties throughout their life, and then they'll decide, all right, now I'm going to leave the final property to my heirs. So then it passes and gets a full step up in basis. Somebody could have began investing in real estate with $50,000 and run it all the way up to $1 million, $950,000 of capital gains, and then leave it to an heir. And after they pass, all of those gains go away. All the capital gains taxes just get to disappear. And that's pretty great. So a 1031 exchange can be one of our most tax efficient ways to get returns. Now, we talked about this before, but it's just good to kind of remind. Joint tenants with rights of survivorship versus community property accounts when it comes to cash or investment accounts. Remember that your joint tenancy with rights of survivorship only gets a step up on the decedent's half. So only the person who dies, their half gets stepped up. If you are surviving and you have an ownership, you don't get a step up in basis on your half, only on the half of the person who died, only the assets that are inherited. Now with community property, because the way I like to think about it is it's the marriage that owns the assets and not the people in the marriage, because the person who survives inherits the assets from the marriage. It's the entire value gets stepped up. So it's kind of like they treat the marriage as its own entity for tax purposes, and the person who survives inherits the entire property, which is what allows the entire value of it to step up and have no capital gains upon that date of death. So the bottom line is that tax efficiency is the final step that optimizes your overall financial plan. Your financial planning, estate planning, and investment selection should remain your primary focus, with tax planning as an added layer of scrutiny. It's kind of like what you want to do, not necessarily last, but when it comes to like changing things around and looking at everything, it should be kind of like that final layer that goes on top and makes sure that you're not losing out on tons of dollars. Don't be so aggressive on tax minimization that you reduce the effectiveness of the portfolio. Like we talked about earlier, corporate bonds and municipal bonds have very different amounts of interest, and it's really dependent on your tax rate which one's going to be more beneficial for you. For people sort of in the middle, treasuries are probably going to be most efficient. For people with really high tax rates, maybe those municipal bonds are good. But with people with average to low income taxes, normal corporate bonds or CDs or anything of the like are usually going to be the best returns on cash that you can get. So consult the IRS website and your tax professional for accurate and specific information regarding tax law and planning. Because, I mean, I'm not a CPA. I'm a financial advisor, financial planner, and I have a decent amount of knowledge, but your tax professional is always going to be the #1 person that can help you with all the little details. So it's important to come up with these solutions, come up with these strategies, but consult with the people who are the specialists in this regard. That's going to be the most helpful. Now, before we wrap up, I want to talk to you a little bit about one of the handouts that we included. So we've got this handout from Fidelity. It's pretty much a guide to tax efficient investing. It goes through a lot of the stuff that we talked about today. First page, kind of just talking about the impacts of taxes on returns. They've got a bunch of really nice charts in here that kind of show different things, your different tax types. So all the stuff that we've talked about, ordinary income tax rates versus qualified tax rates like dividends and capital gains versus net investment income tax and all sorts of different things, as well as things like using a donor advised fund. They talk about bunching up charitable contributions, because if you use something called a donor advised fund, which I need to add into the slides at some point here, a donor advised fund is a cool vehicle. A donor advised fund essentially allows you to make a contribution of cash or appreciated securities to an investment account where you still maintain arm's length control, but it goes into an account that's going to eventually transfer to a charity. So for example, I have a client that did this with Schwab. She opened up a donor advised fund account at Schwab, and we said, we're going to take your appreciated shares of NVIDIA and we're going to scoot $20,000 over here. That gave her a current tax deduction right now so that she could lower her taxable income, but she didn't know where she wanted to donate the funds yet. She didn't know exactly where she wanted them to go. So she was able to put them in this sort of intermediary account, the donor advised fund, where they sat there until she determines this is the charity I want them to go to. Then when she told Schwab that, they sent the money off to wherever it should go. And the other good thing about that too is they actually have estate planning and legacy planning options with these accounts. They will, if you allow them, determine what charities to go to, or you can even elect somebody else to be sort of the trustee of this account and make those decisions for you after you pass. So donor advised fund is really great if you need the tax benefits today, but you're not quite sure where you want the money to go yet. So if you want to make charitable contributions, but you don't really know where, you can send them to a donor advised fund, get the current tax deduction, and then put them to the right charity later down the line. So I'm pretty sure you can keep it there pretty much indefinitely because it's eventually going to go to a charity. It's not like there's not really a time limit on when it has to happen, because you've already, kind of like with an irrevocable trust, you've said, I release control of these assets. So it's already out of your hands. It's already into the hands of them. And if you disappear or there's nobody around to tell them where to put it, they're going to just give it to whatever charity they decide.
with them.
Yeah, it stays with them. It kind of depends on what option you pick. The default for most of them will be that their team will handle it and choose a place for the funds to go. But you can also elect to name somebody else as a trustee or something. Yes.
Just to be clear, it is revocable.
No, DAFs, you can't take it back. You can't take back the money when you put it into a donor advised fund. You're giving up control of that asset. You're not able to bring that back. Yes.
Can you continue it year after year? Can you just to this account, saying this year, this goes, here, this goes?
Yeah, absolutely.
And then put them in your living trust.
What do you mean by put them in your living trust?
Well, it's just an asset that is not gonna be,
Right, but when you contribute to this account, you're effectively giving up control of the asset. So whoever maintains the donor advised fund, they now own it. So you don't own it anymore. You're really just the trustee for those
you
assets.
receive the tax.
Yeah,
benefit.
right, exactly. And that's why you would do it, because you would get that tax benefit. So if you have like an appreciated asset that you don't really need it anymore and you could use a tax deduction. That's why we chose something like the NVIDIA shares, because we were working on sort of moving out of individual stocks to ETFs anyway. And so that was a good opportunity to offload some taxable gains into a donor advised fund so that,
You basically made a donation.
yeah.
That you can control who's going to get it in the long term, but you made the donation, you got the deduction, and you don't have to worry about it anymore.
But I can make that decision, but who that goes to.
If it's a qualified charity, yes.
Yeah.
Yep.
Yeah.
But charity,
Mhm.
I don't have a charity now that I paid for this to go, I can put it in there. That it will go
Exactly.
When I pass.
Yes, you can remind all the charities, they need to be nice to you because you'll make that decision.
Yeah.
But yes, it's a
But it's like-
donation. The tax
Yeah.
deduction, every year you contribute, you can deduct that year or carry it forward
Yeah.
probably.
Exactly. So it basically is just kind of like, if you think you'll know maybe another year or two down the line, but you need the tax break today, that's when you would use a DAF, because that's the most beneficial. It's kind of like, it just gives you time to choose what charity it is. You need the tax deduction. So you're like, I'm going to get this out of my hands into this DAF, and then I'll worry about choosing that later, which is what we were able to do.
And the vehicle, I said that living trust, which is revocable, but that asset is not.
Yeah, this asset's out. It's out of your control. You're basically just the trustee for it, and you're going to decide where it goes
Trustee,
later.
okay.
Yeah, yeah. And there are limits that are important to note. So if you're contributing securities like stocks, there's a 30% of your adjusted gross income that you can contribute, versus if it's cash, you can go up to 50%. So there is a little bit of something there. But when you are contributing the stocks, the full value of the shares, like all of it, you get the deduction for. So if you put in 10,000, it's worth 30, you get to get a deduction for the full 30, which is really nice. Yes.
Or this is what I heard, that you can donate to them and then they invest it and then you get the dividend back from them and it's tax deductible.
Yeah.
And then when you have, they get to keep on.
Yeah, so there's a couple different versions of that. There's like ways that the charity will take the cash, invest it, and then they'll pay you out the income. That's one. There's also another where you can give them a flat dollar amount and they'll actually write up an annuity and they'll pay you lifetime income, and then they'll keep the rest after you pass. So there are things like a charitable remainder annuity trust, or a CRAT, that's one of the methods of which you would put a bunch of dollars into a trust. It would create an annuity, pay that income to you. Then when you pass, all of the remainder of those assets get left to the charity. I forget what the one is called when they actually invest the dollars for you. Do you remember? No. Okay. But I know that does exist out there. But I think it was actually just a charitable annuity. Just a charitable annuity and not a
Some of
trust.
it, yeah, and some of them will take your money for 10 years and then you have to take it back. Or
Yeah.
there's all kinds of strange trusts that the attorneys will write up for you. But the charities will do the simplest trust because they get the money in the long run. That's how they fund themselves, and they
Yeah.
can help you with that.
Yeah.
Yes.
What kind of?
I don't remember exactly what that's called, but you can very much do it yourself with a trust. So like a charitable remainder annuity trust or a charitable remainder unit trust, which I believe is the one that pays out the investment income. It's something where basically you create an irrevocable trust, but the beneficiary is a charity. So it gives you sort of that front-loaded benefit, and you actually get a lot of the tax benefits for contributing those assets into the trust.
Then you get your. then you-
Yeah. It can either kick back the investment income, or it can kick back in the form of an annuity, which will just be a predetermined income amount over your lifetime.
It's not.
That the income that you receive back will be taxable because you get a tax deduction going in, then you get taxable income coming out. So it's like you write off the amount of money that you put in, and then you pay taxes on the amount that comes out, so that if like you live for a super long time, you're only paying taxes on the money that's coming out. And then if you live for a super short period of time, it just kind of like a little bit of taxes and then it goes. So it makes the most sense to get the deduction up front, then you pay the taxes on the income coming out. That's kind of.
And to see a qualified attorney, because you might have a second relative that you want to get income after you pass. So you have to have a really good attorney to make sure there's no break in income stream.
Well, it just kind of depends on how much of the assets you want to have use of. So if your main concern is lifetime income, then it's a fine thing, especially if you're not expecting to use the money for anything else. But if you want to leave assets to a beneficiary, or you want to have more control over it, then you are effectively giving up all that money. You're giving it up so that you don't have control over it. So if being charitable is your number one goal, it's a great vehicle. But if you have other things that are a little bit more important to you, it can be kind of a lockup, and it can make it a little bit difficult to plan around that. All right, any other questions or comments before we get out of here today? All right, well, that brings us 5 minutes past our time. Thank you everybody for coming by, and we've got one more class. Can you believe we're already there?